the like button like a boss, and let's get going.
The Mark Thompson Show.
This guy I've been a fan of his writings for so long. I didn't realize that we went to the same university. Although I think he likes to claim, he likes to claim Columbia as his. I've noticed they kind of talks about Columbia more than he does Colgate. But he is a Pulitzer Prize-winning business writer and couldn't come at a better time given the bailout of SVB. Was it a bailout? Feels like a bailout to me. Let's welcome him now, though. Michael Hiltzik from the LA Times. There you are. Look at you, you handsome fool. All right. Michael.
I don't want to break the camera. So.
I got to tell me what happened. You can review. I think we're all roughly familiar with the X's and O's by now. But again, if you can just review and then tell us how the government's sweeping in and how somehow this isn't a bailout, which is what they're saying.
Sure. Well, Silicon Valley Bank, it had a couple of major problems. One was that all of its depositors came from the same place. They came from Silicon Valley, that is to say, the high tech and biotech industries.
And why is that bad, Michael? Why is that a bad thing?
Well, it's bad because they all tend to move in lockstep. And when this is a very insular community, as I'm sure you know, that they know what everyone knows what each other is doing. And when one gets spooked, as has happened, they all get spooked and they all bailed out at the same time. They all went through the door. But at the same time, Silicon Valley Bank had collected a lot of assets. That is to say, it owned Treasury securities, federal agency securities that it had bought over the years to backstop its deposits, and it bought them all at the peak. It bought these securities, fixed income bonds, when interest rates were zero, so the price and the value of the bonds was at the very top. Well, over the last year, interest rates have just taken off thanks to the Fed, and that means that the bonds lost huge amounts of value. So when the depositors all decided that they wanted to run through the door and get out of the bank had to sell securities that were underwater, that were in the red, and it just could not sustain. There's this just huge mismatch between liabilities, which are deposits, and assets, which are these bonds.
Let me go back for a moment.
One day there was.
Yeah, I didn't mean to interrupt, Michael, but because you are talking about those bonds, what they did was it good stewardship of the money? It seemed like a pretty solid. So they're buying long-term T-bills. I mean, that's not exactly a speculative investment typically.
Well, long-term T-bills are fine unless what you're doing with them is supporting short-term deposits. And then, and this is the way bank runs. Bank runs are always the same. They're mismatched between short-term liabilities and long-term deposits, and you can't sell the one fast enough to cover the other. This is the same going back to the 1870s. Every bank run has been, related to this.
Okay,
so that's what happened on.
So the assets are no longer
Thursday,
worth, and they can't dump them. They can't raise the money.
Well, they can't dump them at the price they paid for them. They started to dump them and were taking huge losses, which they disclosed. They also disclosed that to cover those losses, they wanted to sell more stock, and that spooked everybody. Here's this bank we thought was in great shape. Now it needs this sudden hysterical capital infusion. So everybody tried to get out through the door. The door is just not big enough. On one day, Thursday, there were orders for withdrawals of $42 billion all at once. That's a lot of money. The bank
but Michael, you don't have that kind of run unless it was some sort of, and this is what I really wanted to get to, is it the good old boys or the tech bro network where, one calls another, the Peter Thiels of the world? I mean, and he's almost beyond tech bro at this point,
Peter Thiel, I think, has been blamed for setting this stampede off because, he's a venture investor. He's got portfolio companies that he's basically invested in. And on Wednesday, he advised them all to get their money out of Silicon Valley Bank. And, once again, Silicon Valley, everybody knows everybody else's business. Everybody else said, we better get out too. And the other element of this is that bank deposits are insured up to $250,000 by the FDIC. But all of these companies had deposits at Silicon Valley Bank in the millions, tens of millions, hundreds of millions of dollars that were uninsured. So they had to get that money out, or they feared they would lose it. And that's basically the story up to last Friday.
Okay, so now you cut to Friday when the government comes in and says, we're going to handle this. You know that, as you suggested, depositors who have $250,000 or less will be okay. It'll be covered by government money. The question, though, becomes all of these companies to which you've referred that have all of this other money, as you said, tens of millions, maybe well in excess of that, maybe. And what happens to their money? Because if those companies lose that money, they go under. I mean, big companies that we would know, right?
Yeah, well, it wasn't a question, I don't think, of them losing the money. It was more a question of them not having access to it. When the FDIC took over this bank on Friday, they said, "Look, we're going to cover everybody up to the insured amount, up to 250,000 per depositor. If you, to the extent you had more than that, we're going to give you some of it in the next week. That's this week, and then we're going to give you a chit. And as we unwind Silicon Valley Bank, as we sell off these bonds, we'll recover enough." No one really knew how much they would recover, but it really looked as though the bank was essentially okay, or it had enough in assets. It just couldn't get them in time to cover. So you had venture startup funds, startup companies that said, I've got a payroll that I've got to pay this week. If I don't have the money that's on deposit at Silicon Valley Bank, my employees are not going to get their paychecks. We're not going to be able to pay vendors. We're not going to be able to, pay our cloud providers, what have you. So there was widespread consternation, let's say, across the startup community, and that's when
Consternation's a ding word, by the way. Yeah, go ahead. Yes, yes.
And then finally, so, the Federal Reserve, the FDIC, the Department of the Treasury put their heads together over the weekend. And finally, on Sunday, that's yesterday, they said, we're actually going to cover everybody's deposits up to, 100%. You can get your money on Monday, that is today. And then we'll basically sell off the assets. And if there's not enough there to cover the deposits, we will institute an assessment on all of the FDIC member banks, and that will be enough to cover everything. So the taxpayers aren't going to actually pay a dime.
The banking system pays it, or they through this
The
fund.
the banks, and that's the way the FDIC works. Is they have annual premiums that they charge their member banks that are designed to create this fund that they use to cover banks that have failed.
Now, let me ask you about this. Is this the way it should be? Is this a policy? Meaning the notion somehow that we'll recover funds even if you are not $250,000 or less. Is that policy that we've now seen play out here a policy that makes sense to you, or is it is it an assumption now then that this system, the government system, is taking the risk out of business, but allowing business to keep all the benefits of the risk that business takes? If you follow that question.
We will know, in the fullness of time, but I don't think so. Basically, this is not the first time that the FDIC has said we're going to cover 100% of deposits at a failed bank. It's done that, I think, more than once when the bank is big enough to create possible problems in the entire banking system. And I think that's what they saw here. Basically, if depositors couldn't get all of their money covered, then there was going to be a rush to big banks and medium-sized banks, community banks, small banks, specialized banks, they were going to lose all their deposits because everybody was going to say, well, I'm going to keep my money at JP Morgan and Company or Bank of America or what have you. They didn't really want that to happen. Those banks are too big already. They didn't want them to get bigger. And they were afraid of contagion, that basically people would create runs on other banks. Now, clearly, this is a crisis situation. It came up quickly. It affected, an important sector of the economy. It got a lot of publicity, and I think they were right in saying we have to cover the depositors, but they're not saying that all of a sudden bank deposits are going to be covered for more than $250,000, because most people and most businesses don't keep more than $250,000 at any one bank. If you're a business, especially a big business, you have a whole department that's responsible for taking your free cash and making sure that it's invested, protected, spread around, what have you. This was an unusual situation in which all of these companies, in part because their venture investors said, "Oh, put your money at Silicon Valley Bank. We like those guys. We deal with them. We borrow from them. We lend to them. They're a good bank. So, we think it's fine for you to put all your money in this one bank." And that was really reckless and dangerous. So,
questions that are
you
coming
raised
in.
the question.
Well, before I handle this question about did SVB do their due diligence for investments, especially when loaning out to startups? I mean, it's money that the startups are putting in. It wasn't a question of the startups losing the. I mean, was there? Then I'll get back to my question. I don't think it was. Well, you can answer this.
Well,
Karen's question about due diligence.
I don't think there was any question about SVB doing due diligence when it lent money to companies. I mean, it lent money. It had banking relationships with something like half of the startups in the Valley. And it knew that, some were going to go bad, but, the ones that didn't go bad would cover the ones that did go bad. So it's not their due diligence. The question is the due diligence of the depositors. What were they thinking when they, left these huge sums of money at a single bank? And, you raise the question, is this a bailout? And the answer is, yeah, it's a bailout. But the question with bailouts always is, who's getting bailed out? And in this case, the people getting bailed out are depositors who are essentially, they weren't smart about it, but they're sort of innocent bystanders.
Right.
The shareholders of Silicon Valley Bank, they're going to be wiped out. They're not going to be bailed out. They're going to be wiped out. The executives of Silicon Valley Bank, well, they're going to come under a lot of scrutiny. They're going to get sued, that's for sure, because there were shareholders who thought they were running the bank properly. And just in the last year, the shares of this bank declined by 65%. Because there were investors who said, this is a bank that relies on the venture industry, and venture startups are sort of slowing down, and we're not sure we like that. So they look. But 1 month ago, Jim Cramer, the great guru on CNBC, said, "Hey, this is a great bank. You should buy it. You should buy its shares. It's one of my top picks." And
exactly.
there are a lot of people who think that. There are a lot of people who think that, the idea is you listen to Jim Cramer and you do the opposite of what he recommends, and you'll make money that way.
This is an interesting point. And this speaks to deregulation, which is something that the Trump administration has leaned in heavily for. And it's always being the GOP essentially is clamoring essentially for all these regulations. I call them protections. You can call them regulations. I'd consider them protections right now, right? Those protections to be rolled back. And this speaks to William Lundgren's question. SVB did not have a risk manager. Is that true, Michael? They didn't have a.
Yeah, as I understand it, their chief risk manager left, last year. They didn't fill the position, and to put this in context, the banks that were Silicon Valley's size had lobbied relentlessly to loosen the regulations on them that were imposed by the Dodd-Frank Act of 2010. This was the act that was it was drafted after the last big bank meltdown, and it was designed to basically mitigate the problems that we had then. So these banks, including Silicon Valley Bank, which testified and lobbied for loosening the regulations on banks like itself, they got their wish under Trump, and Trump basically raised the threshold for heightened regulation on banks that were between $50 billion and $250 billion in assets. Well, Silicon Valley Bank, which lobbied for this, went over the $50 billion threshold in 2017, never quite made it to 250, but its assets were in the neighborhood of $200 billion earlier this year. So it benefited from this, basically this liberalization of the rules. Now, whether this would not have happened if the regulations hadn't been loosened, we
Right.
don't know, because the Federal Reserve, which should have been keeping an eye on this bank, was not doing so.
It is true that the bank execs did get bonuses before this bank, quote, went under, right? As Gail is saying here in the chat.
Yeah, the bank execs, they handed out a lot of bonuses earlier last week. It's unclear how far down in the in the employee ladder those bonuses went. I don't think it was only the top few. The CEO of the bank started selling stock last month or even the month before. I'm not sure that any of these people are going to be able to keep that money. And the CEO, basically, he's going to be living with his lawyers for the rest of his life. And that's not going to
Yeah.
be cheap. So I don't know if he's going to end up, being able to pocket this. But, there's sort of a lot of legal fallout yet. There's financial fallout, and we'll see how much of what the bank did was unwise, imprudent, or illegal. I think
And I
it's
know this is
mostly
going.
the first two categories.
You think it's mostly unwise and I'm sorry, what was the second thing you said?
Unwise and imprudent.
Imprudent, which is a damn
I'm not
good,
sure I've
yeah.
seen anything that suggests it was illegal. They did
Okay.
anything unlawful.
In the question of what should happen in the future, this is an interesting point. And again, just as a door to it, here in the chat, are credit unions an answer? Let me just put a slash on that and say, maybe not credit unions, but should there be a nationalization? Stay with me before you call me a big commie. A nationalization of certain banks, or where the feds actually have a bank that you invest in, and then it's insured up to whatever. You don't have to worry about your money. I mean, this since the feds are coming in anyway and somehow making life right for all of these banking customers, should there be some high ground that's associated with the government? Or, and to this question, are credit unions the answer, if you want to answer that too?
Well, credit unions tend to be smaller institutions, so I don't know that they're the answer to everybody. But look, I think the vast majority of Americans who have bank accounts have less than $250,000 in any one bank. So they don't really have any reason to worry. This was, sort of an unusual, if not a unique bank. I've heard from customers who say, it wasn't a very good bank, actually. I mean, we had trouble. We would do transactions, and the transactions wouldn't, they would fall out. They wouldn't be done properly, and they weren't big on customer service. You couldn't walk in. It's not like walking into your credit union or walking into your B of A branch and depositing or withdrawing your money. It was somewhat less accommodating than that. It was really basically a place for startup companies to park the money that they were getting from their VCs, and they were doing it because their venture capitalists were telling them to deal with this bank, and it was almost a badge of honor if you were a startup and had a banking relationship at Silicon Valley Bank.
Right.
Silicon Valley Bank said, we're the innovation economy's bank. So,
and Michael, they do this thing, and you're aware of this, where there's a white glove treatment of certain customers, and that was going on at SVB, where they don't pay the same rate as other retail customers, and the fees and access is all different for certain customers. I feel as though the other part of this story is the way that Silicon Valley was romanced by this bank.
well, I don't know what the range was of services and prices and rates. I think if you came to Silicon Valley Bank because Peter Thiel's venture firm told you to,
I
then
see.
you probably got decent
Yeah.
treatment. But I think every venture firm on Sand Hill Road in Menlo Park, had relationships with this bank and made sure that its portfolio companies had relationships, and that's how this bank got so big so fast during the run up in the venture sector over the last couple of years,
Uh,
3-4 years.
So the last question as we finish up with you, Michael Hiltzik, so generous with your time. You are satisfied with this solution to the issue of then Signature Bank is, alongside SVB, that these banks that become distressed because of the bank runs for the reasons that you've detailed earlier. Are you satisfied the way the feds have found this cure, which is associated with the existing fund to insure deposits?
Well, I think the Fed and the FDIC and the Treasury did what they had to do this weekend so that there wouldn't be, chaos in the banking sector, or really the financial sector this morning. Signature Bank, by the way, is somewhat different. Signature Bank and Silvergate Bank, which failed last week, these were banks that were involved in the cryptocurrency field, and that's just bad news. I mean,
Well, but their deposits were real, though, right? I mean, the money that's sitting there in the bank is real. It's tied to crypto, but isn't it? Or maybe I'm not understanding it correctly.
Well, but their assets were in crypto. I mean, they were basically taking plunges in the crypto business, and cryptocurrency values have just gone through the floor.
So you're
and I
saying
think that's why
they
those
played,
banks failed.
they didn't buy long-term T-bills. You're saying they bought crypto.
Yeah, I'm not 100% sure what their asset mix was, but they both of them made a point of being, we're the bank for you crypto guys,
I
and
see.
that's been bad news. So I think the federal regulators did what they had to do. I think basically they settled everybody's stomach in Silicon Valley, who was afraid that they weren't going to be able to get the money that they needed to pay their employees and do everything else. And I think probably we can, cross our fingers, this is going to pass fairly quickly, certainly faster than it would have if they stuck to the initial idea that we'll cover up to 250K.
Yeah. And it's interesting. I also saw this over the weekend, this notion that there would have been a predatory aspect to various capital groups running in, picking up these assets for 60 cents on the dollar. Essentially, we'll take it for you if you're selling off these various banks. You know more about other stuff than I do, but they're picking up.
Well, I think that's basically what the FDIC is doing, is they're putting these assets up for auction. And I don't know that 60 cents on the dollar is going to be enough. 80 or 90 cents on the dollar may do it. The hold to maturity portfolio of Silicon Valley Bank had losses in the neighborhood of 15% if you actually had to take the losses instead of just hang on. And so I think, 85 cents on the dollar and you can walk out the door with these assets. I don't think it's predatory necessarily.
No, but let me finish with the
predatory
part. Okay, Michael, here's the predatory part. This is the way it could have gone down. It's not going to go down this way. As you say, you'll get 85 cents on the dollar, whatever, and it's done. But I thought, at least in some of the rumblings over the weekend, you were going to see various concerns move in. Again, this would be the predatory thing. You pick it up for 60 cents on the dollar or 70 cents on the dollar, and then you petition the feds for the bailout for the other 30% to be made whole. That was, again, in the zeitgeist of what was going on over the weekend. I thought, wow, that's a scam, that you pick up a company for whatever, you pick up an asset for this discounted price, and then you have the feds make up the discount. That's what I was talking about.
Well, the prices of these assets are all public. They're all traded on the public market, so everybody really knows what they're worth. And there will be an auction, and if it's run properly, which I assume it will be, no one's going to really be able to,
shimmy that
make an
way.
unfair killing. They'll bid what it's worth.
Find him in the LA Times. Find him here whenever he is good enough to be with us. And he really does respond to the bat beam. So it's very, very cool, Michael Hiltzik. Thank you. Albert, you should give Michael a Mark's Madness bracket, just for the hell of it. He's a big sports fan. He might actually rock it.
I'll try to explain it as best as I can, but just click names and see what happens.
Yeah.
Okay.
I would also, exactly, no obligation, believe me. It's okay. You're a very busy dude. You're a Pulitzer Prize winner. Michael Hiltzik, everybody. Maybe he does it. Great to see you, Michael. Thank you. Always appreciate your insights. Thank you, my friend.
Okay.
Yes, I'm very unhappy with everything I've heard today on your show.
Yes. Hi, it's Mark, and I thought that was great. Hit the notification bell. You'll know whenever there's a new video being dropped, and please subscribe to our channel to help us save the universe.